Well, good morning, everybody. I'm David Blount, and I work as a certified financial planner with investment and insurance planning services. And I'm here with my friend and trusted advisor, Janelle Padula from Longwood CPA, who happens to be a CPA herself. And we do some joint work together. And we're talking today in the area of qualified retirement plan design and how to take advantage of the 199A tax deduction. We'll be talking about a lot of things today, and I will pass it off to you, Janelle, to follow up on the introduction.
Perfect, David. Thank you. So what you should be seeing now is the title page of our slides. So if you're not, there'll be a contact us page at the end, but we're hoping that you can see that. And the next slide we have here is just a little bit of background on us, who we are. But at the last slide of the presentation, you will have all of our contact information. So if anything that we bring up today interests you, or if you have additional questions about what we have going on today, just go ahead and let us know, and we'll be glad to answer those for you either by email or phone. So this is kind of a no-brainer. Don't you wish the IRS would let you know where you could have done things better to save more money on taxes? So the real point here is that the IRS isn't going to do a follow-up with you guys to let you know that they owe you money. It's up to you to try to work with your trusted advisors to find those answers and those deductions and those benefits for you, rather than try to wait for somebody else, aka the IRS, to do it for you. So there's a couple of interesting quotes that we found, and it's kind of almost ironic when you read them both in the same context. So our friend there, Albert Einstein, says, the hardest thing to understand in the world is the income tax. And as a CPA, I can tell you that that is 100% true. And then Plato leaves us with, when there is an income tax, the just man will pay more and the unjust less on the same amount of income. I'm sure you can derive from what Plato was saying there is, you know, things that are certain are death and taxes, and you want to pay your fair share so that you can sleep at night and not worry about the IRS coming knocking. And that's why you work with trusted advisors, again, to find those proper loopholes like 199A, which is brand new to all of us, in order to take advantage of those deductions. So of course, if you were given the opportunity, would you rather pay more in taxes or less in taxes? David, I think I know the answer of what I would do, but let's let them know what they're going to learn about, and then they can make a decision there. So what we're going to talk about today: why have a retirement plan for your business? What retirement plans fit for small practices and small businesses? What are the best plans, regardless of the fit? And how do you reduce your business income to qualify for this new 199A tax deduction through innovative and creative retirement plan design? David, I'm going to give it over to you since retirement plans are your specialty, and you can go ahead and explain some of the various plans that you're seeing that are really helping small business and practice owners reap some 199A benefits coming down the pipeline.
Okay, thanks, Janelle. Let's take a look at some of the typical retirement plans for small businesses. Very common types of plans include the SEP IRA and Simple IRA. And then we begin seeing safe harbor 401k plans, individual only 401k plans, and in a few circumstances, pension plans. Now, the IRAs, when it comes to plan costs and complexity, the IRA type small business retirement plans are going to be the least costly, but also may have lower limits on how much you can contribute. Regarding complexity, if you're somewhat financial savvy, you can probably do it yourself on these, but as you move into the 401k and pension type plans, they have more moving parts. They're more complex to set up. There are more players involved in the execution of the 401k plan, but they allow for greater flexibility and potentially better tax savings efficiency for your money than the IRA type plans allow. Again, 401k, pension plans, not recommended for do-it-yourself. You want to consult with a tax professional such as Janelle and a financial planner when looking to set up these type of plans for your business. Especially pension plans are the most technical types of plans. They're not easy to set up. They require high expertise. Plan costs are higher, but not to be discouraged in certain circumstances with very high income earners. They allow very high contribution limits. For example, I have a client that has a defined benefit pension plan, and he's saving over $130,000 per year on a tax-deductible basis. And that even includes a life insurance policy worth $1 million where he's deducting those premiums included in the defined benefit plan. So there's some really fabulous opportunities in the tax code to take advantage of saving a lot more money for retirement and saving a lot of money on taxes. Digging a little deeper, the SEP IRA plan is a small employer pension. These contributions are funded entirely by the small business owner. And in most circumstances, whatever you contribute for the business owner as a percentage of your compensation, you have to do the same for all eligible employees in the plan. And eligibility is a big thing, and it's a determining factor in how much you have to put in for different types of employees. And that's a different conversation. But if you ever look to do a small business plan, that's going to be part of the conversation. Now, the SIMPLE plan stands for Savings Incentive Match Plan for Small Employers. Not so simple. It's a mouthful of words. This is another IRA designed plan, but this plan allows the employees, including the small business owner, to defer salary into the plan. It requires a matching contribution by the employer as well. The Safe Harbor 401k plan is very similar to a regular traditional 401k plan. It must provide for employer contributions, and those are fully vested. When made, it allows the employees to put money into the plan, just like a regular 401k plan. What differentiates it, though, is it doesn't require or be subject to some of the complex annual testing requirements that traditional 401k plans require. As long as the Safe Harbor plan design fulfills certain governmental rules and regulations and check those boxes, say it requires a little less administration and testing requirements. One plan that I really love for self-employed doctors, physicians, professors, and any other type of small business owner, frankly, is the individual-only 401k. It's also known as a solo K or an owner-only K plan. And what it does, it allows the same 401k contribution limits, okay, but it's only for businesses with no employees. So the contributions are only allowed for the owner and the owner's spouse, but it's a fantastic plan for those with no employees. And then pension plans include the defined benefit pension and the cash balance pension plan for very high earners, usually with no or few employees. But what I would say about this is if you're a business owner and you have more than $50,000, $60,000 to put into a plan, and you want a greater deduction and a higher contribution limit, like I shared with you a little while ago about my clients putting away $130,000 a year, and you can actually do more than that in some arrangements, then the pension plan is something to consider as well.
Now, David, profit sharing is also a component of at least a couple of these plans. Can they add profit sharing to a safe harbor in a solo 401k, or is that only on a safe harbor?
No, it actually, good question. It actually applies to both, and we haven't gotten into, and it's probably beyond the scope of the conversation, how the different contributions apply. But yes, to answer your question, profit sharing is a separate contribution done by the business owner in addition to salary deferrals. So yes, safe harbor plans and individual only 401k plans allow for profit sharing contributions.
And in those profit sharing contributions, those are going to play right into a table that David's going to walk us through that's going to give us some of the contribution limits and why we would want to look at what plans make more sense. So that's kind of where we're going with this, David. You've got a couple of questions on the screen there that you're going to walk us through that are going to set up for the chart.
Yeah, I think for business owners, it really comes down to backing into the plan, a type of plan that would be best for them. And you can kind of frame it in the form of a few questions, such as how much income do you want to put away into a plan? Okay, are you trying, so we'll get into in a little while, qualify for the additional 199A tax deduction on qualified business income? How much do you need to put away to get your income below certain thresholds? What are your retirement goals? And those are some of the things, or what's your income and what plan will allow you the highest contribution based on that income. And what I'm going to demonstrate is why a SEP IRA and simple IRA plan may not always be the best choice, although it's easy and it's often the default choice among many professionals. But it doesn't always provide the highest tax saving or contribution allowances for plans.
Okay, and here we have this chart here, and I was blown away when David showed this to me when we started working together. I just think it's a really nice, concise place to start the conversation and to try to figure out, what you want to do as far as set up your goals and how much you can do each year and kind of set the targets. So I'm sure you're using this in that capacity, David, to help your clients reach their goals.
Yeah, I love this chart, and I've been using it for many years. Because it really lays out the options in a straightforward manner. So let's just, for example, say the business owner has earned income of $150,000. If you look across the chart and he or she wants to max out a retirement plan contribution based on that $150,000, well, you can see the SEP plan allows for $37,500 is the maximum the doctor could put into the SEP IRA plan. If we look at the simple, okay, it's $17,000. However, with the 401k, okay, he or she can put in $55,000 off of $150,000 in income. And that contribution is comprised of an employee deferral of $18,500 and then $36,500 in profit sharing, to your point, Janelle. So the combined total is $55,000, but get this, if they're over 50, they get an additional over 50 catch-up contribution of $6,000. So they could really put in $61,000 into the 401k. So what this is allowing, the 401k is allowing basically what you can do in the SEP IRA plan plus an additional employee deferral. So you do the math, what's the difference there in tax savings between being allowed almost $20,000 more in contributions, or we should say $18,000 in contributions, in the 25% tax bracket, that's several $1,000s in tax savings by knowing to do the 401k instead of the SEP IRA. So oftentimes just this chart right here in my practice really cuts to the chase, and a lot of conversation, really helps frame the conversation and help the business owner come up with a great decision and an informed decision in a short amount of time.
And what also happens with the max 25% contribution that David was alluding to, the $36,500, that comes off the bottom line of a pass-through entity. So that's where we start to get into, as we're going to go further, how to reduce taxable income below those thresholds to allow you to take the qualified business income deduction. So not only are you tax deferring and saving tax now and actually putting away this money net cheaper than the $55,000 or $61,000, but then when you combine it with the possibility of getting the 20% QBI deduction, makes it extremely attractive and inexpensive to start to put away that equity.
Yeah, I agree. Absolutely.
So David, if you want to take us through this example that you have here.
Yeah, so if you're a small business owner out there, a doctor or anybody looking, trying to discern, okay, this has caught my attention, what do we do next? Well, either Janelle or I could run a calculation. You can run one yourself from 401khelpcenter.com. And in this example, I have John Doe. He's 50 years old, income $150,000, and his business entity is a corporation. And we can quickly discern what your plan options would be and your maximum contributions for each plan. So this just kind of further validates the numbers on the chart from an independent source. So you can see the maximum profit sharing is $37,500 for just a straight up profit sharing plan. If he wants to do a 401k, he's going to be able to do $61,000 into the 401k, whereas the SEP will allow $37,500 and the simple $20,000. So, the question in the business owners is, where do you want to be and what makes the most sense? Yeah, the 401k, especially if he or she has employees, will have a little more complexity and plan costs. At the end of the day, you're looking at a significant tax savings here. So you don't want to be discouraged from considering a 401k plan for your small business, just because it might take a little bit more work to get it in place.
And the one thing I would also consider, which is a little bit off topic for our conversation, but for any of our listeners kind of really considering the 401k option, if you do have a couple of employees, just that little extra that you're going to be contributing or giving to them essentially may help make them feel more appreciated, may help make them feel more sticky, because we know that one of the most costly things that any practice or business can face is high turnover rates for employees. So there's quite a few additional benefits on top of the fact that you're getting so much in tax benefits. So something to certainly consider on the 401k side.
I agree. That's a great point, because what are the costs to bring on a new employee and get them trained sufficiently to your standards and all that stuff, that keeping an employee or keeping a client is a lot better or easier than finding new ones, right?
Exactly. I think we all find that in our businesses, losing that one employee is sometimes detrimental. So if there's any little thing that you can do, and again, the benefit, it's not what you're paying out in cash, it's actually a net benefit when you consider all the tax savings.
That's right.
And on the tax side, I can tell you that since December 22nd of 2017, when the Tax Cuts and Jobs Act was signed into law, we have now spent almost the entire year, even through the 2017 tax season, trying to wrap our arms around what it is that the government was really intending to do. Much more guidance has come out and is continuing to come out on the Section 199A QBI deduction. And I can tell you from even working with it every single day, this quote from the CPA Journal, that it is anything but straightforward, is the absolute truth. We have models, both available to us and also to David as a financial planner. There are models for this, but even when we use our models, they still don't always nail down exactly what it is because of the interplay between income and wages and the QBI deduction. And sometimes it becomes a circular calculation. So I would say absolutely don't attempt to try to do this yourself. Even if you don't have the retirement plan in place and you're just a small business owner who is looking to find out if they can take the QBI deduction, This is not something to be taken lightly, and it's not something to really try to do on your own. So regardless of the retirement plan piece, you should definitely consult a professional on that piece, and also for cash flow purposes as well, consult your financial advisor on that. So what does the new law do? So this is going to kind of be a little bit of the boring part, because we have to kind of go through this to set you up for the examples and really show you where the large savings come in from a tax perspective. But you really should know the background on who's eligible for this, because if you're watching this, there's a good chance that you are. If you are a sole proprietor and you report your income and expenses on Schedule C of your individual tax return, if you have rental property that you report on Schedule E, or if you're an S corporation, including the very popular here in Florida, LLC with the next corporation election, or a partnership, you're eligible to take the deduction up to 20% on the qualified business income that's earned from the business. So that is not your wages. That is going to be what comes out through the K-1 in Box 1, if you're an S corporation or a partnership, or it's going to be what the net income is for your sole proprietorship on Schedule C, or the net on Schedule E for the rental properties. It's going to be limited to the lesser of 20% of qualified business income, or 50% of the total wages paid for by the business. For the purposes of this presentation, that's probably as deep as we really need to dive into the limitation on the deduction. There is another test, but in our particular case, most physicians are going to be what's called a specified service trader business. And for that, you come up against the threshold pretty quickly. And then after that threshold, you're completely phased out from obtaining anything on the deduction. Some of our other non-service-based businesses have an additional test that they can run through, and that's why we left it off of these slides. So the answer to this question is maybe you're eligible for the QBI deduction because of being a specified service business. So if you're a single physician or a single business owner and you file your taxes that way, if you're taxable income. So this is a little bit different than what we're used to with adjusted gross income. If your taxable income is $157,500 or less, you can take the 20% deduction on your pass-through income, and it's a real nice bonus for you. If you're married filing jointly, up to $315,000 of taxable income, you can take that deduction. If you fall between $315,000 and $415,000 and $157,500 and $207,500 for single filers, you begin to be phased out of the 20%, and there's a complex complication or calculation behind that your accountant would run for you. But you begin to phase out some of it, but you don't lose it completely. When you get above $207,500 for a single filer or $415,000 for a married filing joint filer, you lose the deduction altogether. So that's kind of the importance here of trying to find creative ways to get this deduction, because what it really means to you is that if you're a married filing joint filer and you're at the $415,000 mark, that extra $100,000 of income, you are being taxed on $163,000 because of what you lost. So really just kind of want to find ways to take advantage of this, because I certainly don't want to pay tax on $163,000 when I'm only realizing $100,000 of additional income. And so David, why don't you go ahead and take us through your example here.
Okay, be glad to. And by the way, Janelle, we'll come back to this. You can run scenarios for clients and business owners to determine how and when they qualify, because that's a lot of information to remember.
It absolutely is.
And you guys have software that'll help sift that out and show them what their options are?
Absolutely, absolutely. I think that what we're finding a lot is that the financial planners and the accountants are working very closely during 2018, because we rely on our financial planners for our cash flow analysis to make sure that they can do this type of stuff, but then also to run these numbers. So these tools are available to your financial planner, to your accountant. And if you don't have one and you want to find out, you can always give David or I a call, and we'd be glad to run the numbers for you.
Yeah, I agree. And that's why I like working with you, is because collaborating with somebody like you helps us do the best we can for our clients to discover legal opportunities within the tax code to help them save more money on taxes.
Absolutely.
And that's what we should be vigilant about on our clients' behalf. So an example of this would be, we'll take Dr. Pat. Dr. Pat's single, over 50, independent contractor doing locum tenens work in various hospitals, organized as an LLC, has $150,000 of W-2 income and qualified business income of $50,000 for a total taxable income of $200,000. What we're going to take a look at is how much taxes he'll pay with and without a retirement plan. So we'll assume that Dr. Pat has some margin in his income to be able to put some money away for retirement. And he's interested in taking advantage of doing that and taking advantage of the new qualified business income tax deduction. So in scenario one, he does not have a retirement plan. His gross income is $200,000. Therefore, his taxable income before the deduction is $200,000, and there's no qualified business, so his total taxable income after deductions, $200,000, and his estimated federal tax is $45,668. Now, we'll add, if he happens to live in a high tax state, then there'll be additional state tax consequences on top of that. Dr. Pat implements a retirement plan. We'll say he does, in this scenario, an individual 401k plan. Okay, so he's able to do $18,000 a year in employee deferrals. He can do his over 50 catch up and the profit sharing and max out a total contribution to the plan of $61,000. And as Janelle explained, the good doctor is also trying to achieve the qualified business income tax deduction, and therefore his income needs to be below the $153,000 some odd dollars, right, Janelle?
$157,500.
Thank you, $157,500. And so after the $61,000, his tax of tax deductible contributions to his 401k plan, the taxable income before any additional qualified business income is $139,000. So he falls under that threshold, and therefore will be eligible to take an additional deduction on his qualified business income, which was $50,000. That deduction is an additional $10,000. So his taxable income after all these deductions for business income and qualified plan contributions is $129,000. Estimated federal tax is $25,250. So the tax savings, Janelle, in this scenario is over $20,000.
It is, and that's what I was alluding to earlier, is if you look at that in the context of the plan contributions that Doctor made here, I mean, it's a net, really a net out of pocket essentially of $41,000 when you consider the tax savings. I mean,
yeah, that's right, because it's almost like, because of his tax savings, he put in 61, but he's getting 20,000 tax savings, so his net contribution to the actual plan is $41,000. That's a great point.
And then I think we have here another, we have two more examples, and I'll let David take you through this next one, where the doctor is married in this scenario to kind of illustrate the 415 mark. Okay,
sounds good. Thank you, Janelle. So in this scenario, we have a high income earner. Dr. Jeff is married. Now, he's 100% owner of a medical practice. It's organized as a subchapter S, and he has $150,000 of taxable W-2 income and a qualified business income of $300,000. So his total taxable income is $450,000. We look at the middle column where he doesn't have a retirement plan. Okay, his estimated federal tax is $108,000. That's a huge tax liability. Now, again, Dr. Jeff and his wife have room to be adding a retirement plan. And in this case, Janelle, we're talking about a pension plan,
Okay.
right? Because, you know, a 401k plans aren't going to allow $150,000 tax deductible, tax deferred contribution. Here we're talking about a defined benefit plan or cash balance plan. So this is kind of your higher income earner and looking for a very substantial tax deduction and plan contribution. So he says he can do $150,000 into a plan. Okay, so his taxable income goes from $450 less $150 plan contribution is now $300,000. Since he got below the married filing joint threshold of $315,000, okay, they're also able to take a qualified business income tax deduction of another $30,000, thus changing the taxable income picture from $450,000 down to $270,000. And as you can see, the estimated federal tax decreases from $108,000 and change down to $53,000. Again, over 50% tax savings. You know, that's pretty phenomenal work there, and work that these doctors, you know, would greatly appreciate.
Exactly, David. And I just now caught a little bit of a math error in our retirement plan. So this doctor actually saves quite a bit more. This deduction should be $60,000.
Okay.
That means that his taxable income comes down to $210,000. So his savings are significantly larger than the $55,000 that we're showing here. So actually, this is significantly larger. So again, when you look at that in the context of what that's really costing the doctor net, we're not talking about a lot of dollars here to start socking that money away for retirement. Now, before I go into the final example, I just want to ask you, and I may be putting you on the spot here, but we had talked about, you know, things being a little bit easier on the 401k plan versus a pension plan. Is there a rough estimate of maybe the fees involved so that somebody could really start to determine what route they should take? I mean, for these kind of savings, you know, again, net, the cost cannot be that high, but is there a general feel that you can give to our audience that they can understand what that might look like as far as administration fees?
Yeah, I would say that if you're, again, the self-employed solo practitioner doing an individual K plan, you're looking at costing, you know, I'd say $500, maybe a little more, okay? Depending on the plan and what you want to have in your plan and the investment choices you want to make. Could be a little more, could be a little less.
Yeah, we won't hold you to it, but just to kind of give them an idea.
Yeah, so I would say you're looking at between, you know, $100 to $500 on an individual K. For a safe harbor 401k, you're looking at $500 to $1,000. Now, these are the hard plan costs for the third-party administrators and that sort of thing. That's not included investments and what you actually invest in inside the plan. These are the plan administration costs. Okay. So 0 to 500 on the individual K, 500 to 1,000 safe harbor. And then you can get into a pension plan, you're talking probably, you know, anywhere from $2,500 to $7,500 in plan costs, depending on the complexity and employees and that sort of thing. So, but again, I wouldn't let the plan costs deter somebody from making the best retirement plan decision. You don't want to be tripping over dollars to pick up pennies in these scenarios. And and those costs can often be tax deductible expense. So
I was going to make that point as well. These are tax deductible to the entity.
Right.
And then what we have here, so this is an actual case that happened here in our office. So I figured we would round out this today's talk with kind of showing you the real numbers instead of just kind of simulated numbers. This is actually happening right now. So I have Dr. Smith, who's married and owns her own practice. She's an LLC, taxed as an S corporation. Projected W-2 wages through the end of 2018 of $101,000. and projected pass-through income of about $275. They also employ 2 non-owner employees. So therefore, when you add that up, projected taxable income becomes $376,000 for 218. So as you see, they're about 11 grand, or I'm sorry, 50. My math doesn't work. That's why I'm an accountant. They're quite a bit over the threshold, but they're not at the 415. So they're going to be phased out for a portion of it. So she wanted to know how she could lower her taxable income below the 315 threshold to minimize the tax and become eligible for the 20% QBI deduction, and did not have a retirement plan in place at all. And then I will make a note that our tax calculations in these examples don't take into account the standard or itemized deduction that are now also coming into play in the new tax reform with the increase in the standard deduction and the loss of some available itemized deductions. But for our purposes, I think you can see the tax illustration. So this screen is an example of one of the models that we use here in our office to try to simulate what the outcome should be. And right now in 2018, tax planning and tax projection is pretty much all we're focused on between now and the end of the year, because once 12/31/18 clicks off, as you're toasting your champagne on New Year's Eve, we can do nothing to go backwards. So this is a really key time for everybody to be thinking about what they can do now to save themselves when it comes time to file those taxes. So as you can see at the top, physicians are categorized as a specified service industry. It again outlines the thresholds. And so what this does is take you right down. So we start with our qualified trade or business income, which, as we said, was $275,000. We can see here that in this particular scenario, the owner is putting away $47,000 for themselves and contributing $13,000 on behalf of the employees. Therefore, we come bringing that trade or business income down to just slightly under $215,000. And then the W-2 and qualified property pieces that are coming into this are for the other various tests that if they had to pass, in this case, we don't have to pass them. That's where those would come into play. So they're on the model, but they're not applicable to this particular example. So then we see that the W-2 wages of 101 are entered. So that brings us down at the bottom. So we're $800 over the threshold, even with the qualified plan. But you can see there that the federal income taxes are $54,000. Without the qualified plan, they're $78,000. The difference here is just over $24,000. What that means is even after paying out the employee portion, the $13,000, the owner is still realizing $11,000 of tax savings, and they're making their employees incredibly happy by contributing. This client is extremely happy with this outcome and glad that it's going into their pocket on a tax-deferred basis and into their employee's pocket on a tax-deferred basis, rather than being taken into the abyss of taxes on which you receive zero return.
That's good work, Janelle.
No, thank you, thank you. So in conclusion, this is a lot of material. It's a lot of complicated material, not material to be taken lightly. So again, David and I would love the opportunity for you to reach out if you have any questions about any of it. You can contact us, on our websites or by phone, and we would be glad to meet with you. I know I would do mine on a complimentary basis, David. I think you might offer something similar to that.
Sure, absolutely. Yep.
On an initial consult, and we'd be glad to discuss it with you guys. Anything to wrap up, David?
No, just want to thank everybody for tuning in, and wish them all the best. And, hope to hear from you.